You probably think you already know the answer. A Colonial American shipping company. You're picturing something out of a museum diorama. A tall ship on a painted harbor, barrels of sugar stacked on a wharf, a merchant in a powdered wig signing bills of lading in a counting house. You think the profit came from selling rum and selling sugar in London. You think the profit was on the surface, the obvious side of the ledger. Here's what nobody told you. The real story is not in the hold of the ship. It's not even in the cargo manifest. It's in the math, the operating math, that determined whether a colonial shipping company survived the year or quietly vanished. According to records at Lloyd's of London, during the second half of the 18th century, marine insurance premiums tied to slave trade voyages alone accounted for somewhere between a third and 40% of all premium income flowing through the Lloyd's Coffee House. A third of the leading marine insurance market on the planet, bound up in one category of voyage that most textbook treatments barely mention. Near a third of an entire industry's revenue stream, driven by a single kind of ship. To understand why that single line on a ledger mattered so much, you have to step back. You have to look at the conditions that existed before a colonial merchant ever put a ship to sea. The Atlantic in 1700 was not a free market. It was a regulated one, regulated mostly from across the ocean, in Westminster, through a series of laws called the Navigation Acts. Passed in 1660, expanded in 1696, tightened throughout the century. The rules were simple. Colonial goods had to move on British or colonial-built ships. Enumerated commodities, sugar, tobacco, indigo, eventually cotton, could only be re-exported through British ports. The intent was to make the colonies a captive supply chain. The actual effect was the opposite of what Parliament intended. It generated a vast, persistent arbitrage opportunity for any merchant willing to bend the rules. Because the British West Indies produced far more raw sugar than the islands could refine, and because French and Dutch islands sold molasses at prices that were sometimes less than half what the British charged. So a parallel economy flourished. In 1733, Parliament tried to plug the gap with the Molasses Act, 6 pence a gallon on foreign sugar imports. The law was almost universally ignored. Customs officials in the colonies were paid so poorly that many simply looked the other way. By 1764, Parliament had effectively conceded the point and lowered the duty to 3 pence through the Sugar Act. But by then the smuggling economy had been running for 30 years. According to estimates aggregated by historians, Rhode Island merchants traded roughly 11 million gallons of their own rum for enslaved Africans between 1709 and 1809. Not on British terms, on their own terms. So the conditions surrounding a colonial shipping company by the 1750s were a heavily regulated transatlantic market, a thriving illegal trade, expensive sugar from British islands, cheap molasses from foreign ones, and an ocean so dangerous that an ordinary merchant could lose his entire investment simply by being in the wrong latitude in the wrong month. Which brings us to the central question. How did a colonial shipping company actually make money? Not in the textbook sense. Not by exporting rum and importing sugar. In the ledger sense. Where did the pound on the bottom line actually come from? The answer turns on 3 cost categories that any owner had to clear before a single shilling of profit appeared. First, capital costs, the ship itself. Second, operating costs, the crew, the provisions, the port fees. Third, risk costs, the insurance premium, the probability of capture, the probability of loss. These 3 categories did not behave like modern expenses. They did not behave predictably. And in colonial shipping, the third category, risk, was often the largest single-line item on the entire voyage. Not the cargo, not the wages, the risk. Let's go through each one. Same question every time. What did it actually cost? Start with capital, the ship. The working vessel of the colonial trade was a brig or a small 3-masted ship. Most fell in the 150 to 300-ton range. A typical 200-ton merchant brig, wood planking, hemp rigging, hand-forged iron fittings, might be built in Newport or Philadelphia for somewhere in the range of 1,000 to 2,000 pounds sterling, depending on the year and the timber market. 2,000 pounds. That was the entry ticket, and ownership was usually fractionalized. Nicholas Brown of Providence, whose firm Nicholas Brown and Company became one of the most recognized names in Rhode Island commerce, held interests in 24 vessels at the peak of his career. 24. Most merchants owned a piece of a ship. Few owned the whole thing. And the capital number did not stop at the hull. Outfitting, the ropes, the sails, the anchors, the provisions loaded in advance, the cannon if the vessel carried any, could double the initial outlay before a single barrel of cargo crossed the deck. By any conventional analysis, a merchant tying up that much money in a single Atlantic voyage was a gambler. Most of them were. Next, the people who actually sailed the ship. The operating category. The numbers here come from wage records assembled by historians like Gary Nash, working from port books in Boston and other colonial harbors. A common seaman in Boston in 1770 earned roughly £1.50 to £2 sterling per month. Common labor on shore paid roughly a third of that. Officers earned more. The captain of a 200-ton merchant brig might draw £3 to £4 a month. Skilled tradesmen, carpenters, cooks, pilots, sat somewhere in between. A typical New England to West Indies outbound run took 6 to 8 weeks. A full triangle voyage, down to the Caribbean, then sometimes over to Britain, then home, could easily run 4 to 6 months. By the late colonial period, a significant share of voyages were longer than that. Across that time, wages alone on a 14-man crew ran somewhere in the range of £80 to £100. Not catastrophic, but not trivial either. Then came provisions. Salted fish, salt beef, hard bread, peas, water, rum. The standard daily ration for an Atlantic sailor typically included roughly a pound of biscuit, a portion of salted protein, and the beer or rum equivalent of a gallon of liquid. Across a 6-month voyage, the food bill on a single ship could approach £30 to £40. And by 1770, those costs were trending upward. Then came port fees, pilotage, wharfage, customs duties, when there were any honestly paid, and the customary fees expected by colonial port officials. In Newport and Providence, many customs officers were paid so little by the colonial government that they effectively sold their services to whichever merchant wrote the largest personal note. So by the time a ship cleared the harbor, the operating ledger already had several £100 stacked on the cost side, before a single barrel of cargo had crossed the deck. Then, the third category, risk. Here's where the math gets strange. And here's where the Lloyd's number, the number that opened this whole story, stops being an interesting footnote and starts being the whole story. Marine insurance in the 18th century was not a routine line item. It was often the single largest cost on the voyage, and the rates varied enormously by route. A coastal trip between Boston and Newport, on a hull that the underwriter knew and had seen many times, might attract a premium of 0.5%, essentially negligible. An Atlantic crossing to a friendly port in the 1760s, somewhere in the range of 2 to 3% of the insured value. A slave trade voyage in the same period, considerably higher. According to research published in the Journal of Economic History, marine insurance premiums on British slaving voyages during the second half of the 18th century routinely ran between 7 and 10% of the full value of the ship and cargo. 10%. Added up, on a slaving venture with a total insured value of, say, £8,000, a figure well within the range of the syndicates that operated out of Newport, Providence, Bristol, and Liverpool. 10% of 8,000 was £800 in insurance alone. Roughly the cost of building the ship in the first place. £800. For the privilege of being allowed to lose everything. Most observers of the trade, when they thought about it at all, assumed this kind of premium would eventually suppress the trade. By any conventional analysis, the numbers should not have worked. They did. Here's the problem. Here's the mechanism that nobody told you. The reason colonial shipping survived, and the reason some merchants grew very rich, wasn't that the obvious costs fell. Shipbuilders didn't get dramatically cheaper. Provisions didn't get dramatically cheaper. Crew wages didn't get dramatically cheaper. What changed was that the risk premium itself became the seed capital for the next voyage. When a successful voyage completed, the proceeds of sale at the destination were split between the syndicate partners according to a prearranged formula. The insurance premium, having been paid out at the start of the voyage, was no longer on the books. But the next voyage, the merchants would insure again and again, and the merchants who controlled the syndicates understood that if a ship was lost, the insurance payout underwrote the replacement hull. The risk premium was, in effect, a forced savings mechanism. You paid it whether the ship came home or not. If the ship came home, you absorbed it into the cost base. If the ship didn't, the underwriter absorbed it for you. Either way, the next voyage was already funded. The colonial merchant's real wealth often wasn't a single ship. It was the network of insurance contracts, partnerships, and commodity agreements that determined who got to write the next voyage, who got to absorb the next premium, who got to put up the next bond. Which brings us to the human layer. This is where the numbers start to do something that figures aren't supposed to do. They start to weigh on the people around them. Average mortality rates on slave trade voyages during the Middle Passage, again according to the scholarship, ran somewhere in the range of 12 to 20% during the late 18th century. A study by Raymond Cohn published in the Journal of Economic History finds voyage death rates above 40% on a meaningful fraction of vessels. The average seaman on these voyages, not enslaved, just employed, spent most of his career within sight of his own death. A regular colonial sailor earned roughly the same wage as a Boston laborer earned in a week and a half. For that, he accepted roughly a 1 in 5 chance per voyage of dying at sea. The economics were clear. The arithmetic was unambiguous. The arithmetic is what made the system run. The ledgers do not record the names of most of these men. The ledgers record the costs that flowed around their deaths. The insurance payouts. The wages owed to the next of kin when there was a next of kin. The numbers on a shipowner's books were not abstractions. They were weighed on the bodies of specific sailors. Even the merchants who operated on the legal side of the trade operated with these numbers behind them. Nicholas Brown and Company of Providence diversified heavily into privateering during the Revolutionary War years. According to research aggregated at the Battle of Rhode Island site, John Brown, Nicholas's partner in the broader Brown family network, invested in armed privateers during the 1760s and 1770s and realized captured prizes worth somewhere in the range of £420,000 across the conflict. £420,000. From Captai.